Good afternoon, everyone, and welcome to this session on automating foreign exchange in a post-COVID world. Let me first introduce myself. I'm Khuntia. I manage the global FX sales for the Barclays Corporate Bank. My team has team members globally from Far East to Middle East to continental Europe to UK and in the US. Now, this footprint really helps us in interacting with our corporate clients, treasury clients, across the globe and understand what their pain points are and what their priorities are. So a lot of this contents on this presentation is basically insights gathered through those client interactions that we've had. The client interactions is what truly provides us some of those insights. Now, the structure of the presentation is quite simple. The structure is what I'll first do is I'll first provide a little bit of a background in terms of what's happened in the post-COVID world and how does it compare to what it was, prior to the crisis. And then I'll focus on particularly some of the trends that have been happening in this particular space in the automation of FX. I will mainly highlight four trends that have happened. I will go into each of them in detail. And then what I will finally do is bring it to life with two case studies, live case studies from our client examples. And then, I certainly believe that those two client study examples are from different industry sectors, and I'm sure you will appreciate that. Now, before I launch, a little bit of housekeeping. So, I would love to keep the session as interactive as possible. So please feel free to submit Q&As on the, I think there's a tab on the top left-hand corner of your screen. So I encourage everyone to go and submit the questions. So on that note, I will start my presentation. Yeah, so the first thing is a little bit of a background in terms of what has happened so far. So the market volatility has been massive. I mean, that's what we saw in the month of March and going into April as well. So that's what the chart on the left-hand side basically shows. So we saw some massive market volatility starting from early March onwards. And some of the key stats are there in the slide. So basically we saw on sterling dollar, we saw massive moves over a 10-day period. There was a 13% move is what we saw. I was just looking at some of my charts as well. So on the 9th of March, for instance, cable, which is sterling dollar, was on 131 handle. And on 19th of March, it was on 114 handle. So it was a massive move that happened. It was a 12 standard deviation move, which is fairly rare in the FX markets. So this level of volatility is what our clients experience. And it's very difficult to manage the treasury if the FX volatility is to these levels. The single day intraday swing basically for cable was 5.8%, which I believe was on the 19th of March. So there's a lot of, I was just close to the dealing channels and, we're just hearing so many things from our clients as they were calling because everyone wanted to manage their FX risks and more importantly, the FX execution in such volatile environments. So if you look at the chart below, what you will see is we plotted the 1 week volatility for a number of currency pairs. So if you see right on the top is the Russian ruble. I mean, some of the emerging market currencies and the commodity currencies like the Russian rubles, South African rand, many of these currencies had absolutely massive moves, 20-25% moves over a very short period of time. And we also had, corporate clients who were exposed to some of these currencies. So it was incredibly difficult period for many of them. So some of those memories are still quite fresh. Ever since the volatility has kind of come down, but from time to time, we start seeing volatility coming back into the market as well. Now, on the right-hand side, what I'm basically trying to show is, so the left-hand side was all about the impact to the FX markets. On the right-hand side is how did it impact the behaviors of the end consumers or end customers of our corporate clients, as well as the experiences that our corporate clients had in terms of managing their businesses. So some of the proof points is basically the use of digital channels across increased massively. So some of the stats that we could glean, there's a 16% year-on-year growth in the retail e-commerce. So the online sales kind of surged. I think someone was sharing statistics with me that Amazon, which has been one of the biggest beneficiaries of some of these moves to the online channel, had something like 25-26% year-on-year growth. It's already on a fairly large base number. So there was a huge move in that particular channel, and I've got some clippings, that we saw in the last few months across again sectors. So L'Oreal, consumer goods company, massive move in their digital channel. Sales grew 53%. Inditex, Zara, saw online sales surge 95% in the month of April. And I've also seen they've announced massive investments in that particular channel. So the big online marketplaces in Far East like Alibaba and JD.com, very similar numbers. Farfetch, very similar 90% growth. Now, these are just examples of some of the consumer digital channels. But even in our workplaces, the change has been pretty similar. We've all got used to working from home. We've all, have been leveraging the digital channels as we've never done before. So these two things, I guess, I think are the most important trends in this post-COVID world, is that market volatility has come back, and it probably will remain for quite some time. We will increasingly be leveraging the digital channels. Our consumers and end clients also would want to access our products and services through the digital channels. So it's very important that we are focused about some of these trends. Now, I move on then to what's the core of my presentation, which is basically four trends which are driving the automation of FX management in the treasury space. So these four trends have been there. They existed pre-COVID as well. But based on what we have seen in the last 3 months, there's going to be a massive acceleration of some of these trends. So the first one is digitalization, which I briefly talked about, but I'll probably show some more stats with respect to the FX channels. The second bit is about transparency of price and rates on the FX channels. The third bit is about innovations that's been happening in this space for more than a decade. And then the end result of all of these is greater efficiency, better cost management for our end clients. So that's going to be the focus of my presentation. So I'll go through each of them one by one. And then, as I mentioned earlier, I will bring it to life with 2 live case studies from our client examples. So the first one is basically digitalization. So FX distribution continues to get more and more digitalized. As you can see, basically what I'm showing in this chart is the FX distribution by channel, daily turnover by channel. The blue part of the bar is basically the voice channel, which has been the traditional channel for distribution of FX products and services. And then the gray bar, which is basically the electronic channel. So as you can see, in 1992, almost all of it was basically voice channel. I mean, that's how this product was traded and executed. And then around 2001, which is the time of the dot-com era, you started seeing gradual penetration of electronic channels. That's when the electronic platforms started getting launched by the global banks, by the FX brokers, and so on and so forth. But still, it was predominantly a voice business. 85% was still voice business. A very small percentage was electronic. And then fast forward to 2019, and then what you find is 60% of the FX distribution is now going via the electronic channels, and only 40% is via the voice channels. Now, there will always be a need probably for voice channel. There are certain types of transactions. They may be particularly complex, or they may be in illiquid currency, the illiquid markets, and that's why both the channels will probably coexist. But it's fair to say that the penetration of electronic channels will continue to rise, as we've seen. And these electronic channels are both single dealer platforms as well as multi-dealer platforms. So banks and FX providers invested in their own platforms, as well as the industry multi-dealer platforms also evolved. And both, what it has resulted in is massive increase in daily FX turnover. So if you look at it, $770 billion was the average daily FX turnover in 1992, and it's gone up to 6.6 trillion daily turnover of FX transactions. So this is again a key, conclusion out of it. As the products and services have been digitized and we've delivered them through the electronic channels, it has the benefits have seeped into various client segments, and therefore the usage of some of these solutions has improved. Not to mention, of course, greater globalization and across across industries that we've seen, and globalization of supply chains. That's also certainly helped with this one. So that's kind of my first trend, which is increased digitalization. Now, the second trend that we've seen is price transparency. Now, price transparency has always been front and center in the minds of our clients who've been consuming FX services. Now, the FX prices were not as transparent, say 10 years back, as they are now. But now, with the use of technology, providers are able to live stream the FX prices across channels and across client segments. The first beneficiaries of this, of course, were the institutional and the big corporate clients. But these benefits are now available to individual consumers as well. So on the left-hand side, I'm showing an example from our corporate banking web channel, where we have thousands of clients who basically book their FX payments transactions through those channels. We have 100 plus currencies available in which they can pay or pay their suppliers or beneficiaries or receive monies from their clients. And what you see here is essentially what we do is we make the live mid-rate visible to our clients on the screen. And they're also able to see what's been the margin that has been applied, which is generally pre-agreed with the clients. So that price transparency, I guess, gives a lot of confidence to our corporate clients to conduct the transactions. And more so in these types of environments. I mean, one other thing that I probably didn't mention is during those few weeks of extreme FX volatility that we saw, the other thing that also happened was that the bid-offer spreads are also widening, particularly for the EM currencies, but even for the major currencies as well. So in these types of situations, our clients would certainly want to see the rates that they're paying for their transactions. So increased visibility is always very useful. And we've always been complimented by our clients for this price transparency. So this price transparency, and I'm not speaking only on behalf of Barclays, but also on behalf of the industry. This has been a very big move by the industry, and it's benefited our clients tremendously. So price transparency has, definitely across the corporate treasury space, we've seen that. On the right-hand side, I'm just showing an example of how similar benefits can also be provided to individual consumers. As you can see, what's available to a corporate treasury client on a banking channel is also available to an individual consumer on their mobile apps. Now, I've taken a screen grab from one of the popular, FX apps, and you can clearly see that if an individual consumer is trying to make a payment in this example, a sterling euro transaction, they're able to see the FX rates. They can compare it. They can just Google it. They can compare it, and they can see whether the rates that is being made available to them is attractive to them or not. So that's the kind of price transparency that's happened in the consumer space as well. And this kind of ties back to what I showed earlier as well, right? Which is distribution via electronic channels and greater price transparency, which inspires confidence, means that across client segments, more and more consumers and corporate clients and even financial institution and non-banking financial institution clients have started to use these services a lot. I'll move on to the next slide. Now here I'm discussing about the innovation, which is kind of the third trend. So we talked about digitalization, we talked about price transparency. Third trend is basically innovation in this space. There's a tremendous amount of innovation that's been happening, particularly in this FX and this payment space. This kind of confluence of this FX payment space has been seeing a lot of innovation. Now, what I'm trying to show with this particular outline diagram is the cross-border payments when they're done. There's a lot of thing that happens behind the scene, right? And that's what makes it a lot more complex and time taking. So showing an example where there's a payer in country A and they are making a payment to pay in country B. Now you can see there are at least four financial institutions or banks involved in this. And then what you also have in the mix is the payment infrastructure in both of these countries, right? So it has to go through a number of steps, right? And by and large, it has worked. It has worked very well, and that is what has aided the explosion and growth of the cross-currency payments globally. But as you can see, the more the moving parts, the more the friction. And I think there's a lot of work that's going on in this particular space. There's a lot of innovation that is going on in this space. There's no one particular innovation that I can mention, but I thought maybe one or two are worth mentioning. So one of them is the use of distributed ledger technology, DLT as it is known as. So there's a lot of pilots again going on in terms of can we reduce these types of frictions through some kind of smart coins or through some kind of a similar mechanism which reduces the frictions and touch points that we notice in the traditional channels. Now, I must qualify that by saying all of them are in pilot stages right now, and it will take many, many years, maybe even decades, for these types of innovations to become mainstream. But the good thing is there's a lot of investment that is going on into this particular space. Both banks, fintechs, as well as the regulators actually have been collaborating in this particular space. The other interesting development in this particular space is a lot of the central banks have stepped in as well. So all major central banks, People's Bank of China, Federal Reserve, and yesterday even the Bank of England basically announced that they're all exploring some form of digital coins. So there's going to be a lot of investment in this particular space, and we'll see a lot of innovation in the years to come. So the other innovation that I would probably want to highlight in this cross currency payment space is the Swift GPI initiative, which many of you may be aware of, and that again will take many years to come to fruition. But increasingly, all the major banks are participating in that, and in its end state, it will really afford trackability of cross-border payments for the payer as well as for the payee, and that would be a massive step forward in this area. I'll go to the final area, which is around efficiency and cost management. So efficiency and cost management is kind of the end goal of all of these automations um, and these digitalization moves. Now, there are a number of stats available. What I've picked one is a white paper from McKinsey, which was published a year or two back. And it actually makes a very bold prediction. It makes a very bold prediction that the end result of these automations will be that the cost of conducting international cross-border transactions will come down to the levels that we see for domestic transactions. I mean, if you read the finer prints and the details of this white paper, what you'll find is there are lots of assumptions that have been made. And again, a bit like the previous slide, this is a multi-year journey, could be decades as well. But the interesting thing to note here is that in the end state, if this were to be realized, that the cost of conducting an international payment transaction becomes similar to a domestic payment, then it will open a large number of new services that our clients can deliver to their end clients, which are currently not possible. Now, as you can see from the bar diagrams, I mean, for conducting these types of transactions, there are a number of costs involved. There's liquidity costs, there are operations costs, there are compliance costs, not to mention the FX costs and so on. You would expect that some of these automation trends will certainly help reduce some of these costs and that is what will help with some of these efficiency gains. So that's basically the four trends that I was mentioning, which is digitalization, transparency, innovation, and efficiency. So those are the four that are there, right? That I thought worth mentioning. Now I'll bring two case studies which kind of bring it to life. So the first one is um, is a case study from actually the travel sector. So our client is actually a travel wholesaler. They are also known in the industry as bed bags. I mean, this is actually a very blue chip travel, a global travel company, and they have large numbers of businesses, very diversified businesses. One part of the business is basically a travel wholesaler. Now, what's the business model of a travel wholesaler? It's basically a B2B business model. So they basically, what they do is they buy services from hotels all over the world, as well as holiday service providers, and so on and so forth. And then they make it available to the travel agents, both online travel agents as well as the high street type travel agents. So it's kind of an intermediary, a wholesale intermediary in this particular space, but it plays a very important role. And these travel wholesalers, there are quite a few of these travel wholesalers. They tend to have massive footprints globally, where they have sales force who are doing these deals with these hotels and other properties and making them available to travel agents. So in this particular example, what I'm showing is that the travel agent has an end client who is based in the UK and is making a holiday booking in Thailand, um, and they're due to travel, let's say, after 4 months. Now, let's also assume that the payment term that the travel wholesaler has with the hotel is 1 month. So they're due to pay the hotel in 5 months' time, and the end consumer is expected to pay after 4 months, right? Um, so basically, in this situation, what you have, the travel wholesaler has an exposure of 4 months to sterling, and a 5 month exposure to Thai baht. The base currency for this travel wholesaler is US dollar. Now, this is a typical problem that we face, right? In almost all industries, right? We have our end clients on one side who choose to pay in a different currency, and then we have suppliers who invoice in a different currency. So it's kind of a very standard situation, right? That we see here. Now, what complicates this situation a little bit is a few things. Number one is that we have a currency mismatch here, right? I mean, that is clear. The other one is that these tend to be micro transactions. So normally in a corporate treasury, you would use traditional hedging solutions and you would hedge them, right, and have some kind of a solution around it. But these are all micro transactions. The transaction values are very small, typically two to 5,000 pounds. I mean, that's what we saw. It's very small. It's individual bookings coming in from their travel agents. The other issue with this is the exposures could be pretty long dated. We have exposures going up to 24 months. Sometimes some people book holidays maybe 12 months, 18 months, 24 months in advance, right? So it could be a fairly long term exposure as well. The other unique thing about this particular industry is that cancellations and refund rates could be massive, and that creates a huge amount of risk. And I'll give examples of specifically what we saw in the last few months in this particular sector. So cancellations tend to be high. We had done the analysis with this particular client, and we found that level of cancellation of something like 30%. Um, it generally achieves their risk appetite 90% of the time, right? But then you have these types of crises like we had in the month of March and April, where the cancellations could be massively higher. Now, why it creates a risk for them is the exchange rate that was used at the time of booking versus the time of cancellation could be quite different. Now, traditionally, when I've spoken to a number of corporate treasuries, what do they do about it? They probably have some form of a suspense account, which is called a FX gains or loss account, and they manage that. And it creates its own, accounting challenges and other issues with that. So there's always been, from a number of sectors, there's always been a demand for a solution which can handle this cancellation and refunds risk as well. So what did we do? So we basically have a number of automated FX risk management solutions. So there is one particular solution that we have, which we call Barclays NetFX. That's one of our premium solution. So we adapted that solution to the requirements of this particular travel clients. Now, what we did was it's a complete API based solution. So we connect to the platforms of the travel wholesaler via APIs. And then as individual transactions feed into their platforms, some basic level of detail about the transaction comes into us, right? And that's very helpful because that helps us, risk manage those transaction flows as well. Now, as each of these, like for instance, in this case, this sterling Thai baht transaction comes in, what our systems will do is do an automated FX forward, will be booked for each of these legs. So in this particular example, a 4-month sterling dollar, 5-month dollar Thai baht will be booked, and it will be then actively risk managed by us. Now, the thing is, the volumes are huge. It's like we're talking about hundreds of thousands of bookings, every month. So it's a very large number of volumes, which could, manually be almost never be done. I mean, I've spoken to some other clients in this sector as well, and basically what they do is they do an approximation in terms of cash flow forecast, which inevitably will never be accurate, and then that creates some kind of a error in terms of their risk management. But with this type of a solution where you're almost doing the hedging at a micro transaction level, there is no forecasting. I mean, you're leaving no room for error, for forecasting errors. So so we risk manage all of these flows, and then if and when cancellations do come in, they communicate that to us again via the same API link, and we refund them at the original FX rate in which the transaction had happened. Now, what is the experience during the COVID crisis was? So they have a number of their travel businesses here in the UK as well. It's a global company, but a lot of their businesses is UK travel agents as well. So around the month of mid-March, a lot of cancellations started happening for obvious reasons, because people are canceling their holidays, the Easter holidays, as well as their summer holidays. So the cancellation rates kind of peaked at that time. So we refunded all of those transactions to the client because we had already risk managed them at the original rate. And speaking to the client, it was massively beneficial for them. I mean, they were in a travel sector, right in the eye of the storm. One less problem. One less problem was to manage all of this FX risk that was getting created due to this massive cancellation spikes that was happening. Now, the other thing about this particular solution is everything is automated. The reporting, reconciliation, everything is automated at an individual transaction level. So if anyone needs to interrogate any particular transactions, they can go to a unique reference number, transaction reference number, and they can pull out the details of the transaction. So this is an example of what we had done for a B2B client. It's a travel wholesaler, and we are looking, there's a decent amount of client demand from this particular niche sector for these kinds of solutions. So this definitely is one of our showcase client solutions, I would say, in the FX automation space. The next one, the second case study, is actually from a slightly different space. It's from a B2C, business to consumer space, and it's basically a global online marketplace. Now, everyone is familiar with how a online marketplace works, but essentially, what you have is you have buyers and sellers in different currencies who have different base currencies, right? So I'm showing an example where buyers have base currencies, which is US dollar, euros, and pound sterling. And on the seller side, you have sellers whose base currencies, I've just taken some examples: Chinese yuan, Japanese yen, Malaysian ringgit. Now you have a situation now that a seller, let's say, has a base currency of Malaysian ringgit, wants to sell to all these three buyers that I've shown on the left hand side, right? So they are exposed to the volatility their base currency has against all those three. And the daily volatility could be quite significant. I mean, for a currency like Malaysian ringgit, it could easily, intraday moves could easily be 2 or 3%. Now, for a lot of these sellers in these online marketplaces, the margins are fairly narrow. There's not much margin there. So you want to remove as much of FX volatility as possible. So the solution that we developed is, sorry, before I get, the challenges, if I have to summarize it, is the one is the mismatch of the currencies, which creates an exposure. There is a FX rate fluctuation, which we spoke about. Now, another thing needs worth mentioning here in this particular sector and in e-commerce sector widely, what we see generally is number of clients have like a budget rate or something like that, which they leave it for a month or 3 months or so on. And that creates its own problems, right? Because then the rates that you have put on your websites is not necessarily the rates that you're executing on. So there's a gap there. So the challenge, I guess, is how do you remove this FX rate fluctuation, this FX volatility, while keeping the rates fresh and competitive? Now, this particular space, if you've noticed, right, the online marketplace is very price competitive, right? So having rates which are tight, fresh is incredibly important. Now, what makes it complex, a bit like the previous case study, is again, there are millions of microtransactions. It's actually, the challenge is much more than the previous one. The previous one, I said, average ticket size of a transaction could be somewhere between £2,000 to £5,000. Here, the average ticket size of the transaction would be somewhere around 20 to 30 pound kind of range. And they have, businesses in multiple countries, maybe 40 or 50 countries. So they're dealing with a very large number of currencies here. So the solution that we developed was kind of similar, which is we, again, connected to their platforms via the API. And we essentially, what we do for them is we lock the FX rates, as in guarantee the FX rates for all the currency pairs that they have a demand for. So we send them locked FX rates early in the morning, their time, via the APIs. Their platforms then absorb those guaranteed rates for 24 hours and reprice all their products and all their websites. So for instance, if we've sent them, US dollar Malaysian ringgit, then the Malaysian ringgit sellers goods will be priced in US dollar early in the morning their time, and it stays locked for 24 hours. Now, what that happens is, now behind the scenes, of course, we are risk managing those flows, right? We're risk managing, so they've effectively outsourced the risk of some of those FX volatilities to us. Now, for the seller, if you look at it, now the margin is completely locked, irrespective of what happens to the currency pair. And that's a huge benefit for them. Now, typical sellers have margins which are like 5 to 6%, right? So, 2 to 3% moves could wipe out a lot of their profits. So margins are locked for the sellers. The marketplaces have an option. They can add an FX margin if they want, and that creates a new revenue stream for some of them. And as like the previous one, the reporting, reconciliation, everything is automated. And finally, the same point as the previous one, which is cancellation and refund benefits are provided to the client. And these are generally pre-agreed, the levels of cancellation for what period. And again, post-COVID, what did we see? Post-COVID, again, after mid-March, this was not travel sector, this was retail sector. So the problems were slightly different. Here, the problems were that there were a lot of people who were wanting to buy on the online channels, but the sellers just didn't have the inventory or the goods, right? So a lot of payments were being made by the buyers to buy products and services, but the sellers were just not able to fulfill them. And after a few weeks, those transactions have to be canceled. So there was a bit of a lag, but probably from April onwards, a lot of cancellations started coming in these channels as well. Now, again, the rate movements were massive, which I discussed on the first slide, right? I mean, the rate movements on sterling dollar was about 13%. right? So we honored the original rates at which the transactions were done. So which means for the online marketplace, for the sellers and the buyers in this ecosystem, the FX risk or the risk due to the FX volatility was completely removed. So this is another example of a solution that we've implemented in the e-commerce space. And again, we have a number of clients who are beginning to use some of these solutions as well. So if I go back and if I have to conclude, so there are certain types of similarities, if you can notice, among these solutions, right? Um, One is that we try to automate it as much as possible so that there is minimum human intervention that is required, and that's great, right? I mean, particularly in this type of stay-at-home remote environment where most of our corporate clients are working remotely and the treasury staff are working remotely. I think you want to reduce your reliance on manual processes and voice channels. So this is great for that purpose, right? So the only thing that I would mention is that, yeah, it does require a lot of consultation initially when we work with the clients in terms of developing the solution, because solutions have to be bespoke to the requirements of the business models. And even two similar clients in the same industry could have slightly different requirements. So there's a little bit of work that needs to be done, collaborative work between us and the corporate clients. But once it is done, it has immense benefits for the clients, as we've seen in the last few months. Now we've spoken to a number of clients about these types of solutions, and what I'm noticing as a trend, there's a greater appetite for doing these types of implementing these types of solutions, given the volatilities that we've seen in the market. Now, I've got about 9 minutes, so I'll probably take a few questions. I've got some, but feel free to send me any other questions as well. Um, yeah, so there's a question. Let me read. Yeah, so this is a really a very good question, actually. So I'll read it as the question has come. So in your case study about the travel agent, it sounds like outsourcing of FX risk management to the bank rather than FX automation. How do we ensure competitive quotes if we choose to be reliant on any one bank? I think it's a very good question. This comes back to my point earlier about price transparency. So yeah, I've just gone back to that slide of that particular travel client. Yeah, so I probably didn't explain in terms of how we price. This is very much like the next slide as well. So with this particular client, there's I think about 2 dozen currency pairs that they want the prices in. We sell it to them again. I think 9 a.m. their local time, and the rates that we send to them are basically our mid rates, right? So they are the prevailing mid rates of the time. And since we are one of the larger market makers, these rates would tend to converge with all major fixings, Bloomberg, Reuters, any other fixing that you see. We've done this analysis, and we do it, for all our clients as well. We show this analysis to the clients. Our rates will converge with the fixing. So pretty much these are kind of the market rates. And we price it from the mid. We will price it from the mid, and the spreads that we charge for holding these rates or guaranteeing these rates are very small. So the way I would probably answer this question is, I think there are two elements to it. There is definitely an element of outsourcing of FX risk management, which I think provides a lot of services to our clients, and it's fully automated as well. Because these prices, as I said, we always, if a client wants us to benchmark the prices that we have provided to them via these API channels for any period of time, we're more than happy to demonstrate that these rates indeed were as per the mid rates prevailing in the market at that particular point in time. So again, very happy to take this offline as well. But I hope that kind of answers the question. The question is about the competitive quotes as well. And again, some of these clients who've implemented these solutions, they're free to compare the rate sheets that we send to them to the market rates that they get in their terminals. And we've never had any reasons for any complaints on that part at all. So that hopefully answers that question. I've had a few more, so let me go through them. Yeah, so there is a question here. Let me read that. Um, yeah, we are reading. We are hearing a lot about. Okay, let me say it in my language. We are hearing about API based solution making an impact in the FX world. What are some of the trends there? Okay, so the way we look at it is API is a very modern way of connecting financial institutions with the clients. It's a relatively light connectivity compared to traditionally what we've seen. So APIs are very much things that are becoming popular in the world of FX payments and other corporate treasury services. They're definitely the future. There's no doubt about it. It's a live interactive channel. So, like in some of the examples that I had given, all of these clients are actually connected via the API, which provides a live channel. So, if they want to fetch FX rates from us, they send us an instruction via that API, which is a live channel, and our systems interact, uh, you know, live and send them the FX rates. If they had to execute as well, they send the instruction and it happens. So it's kind of a live channel. It's a nice light connectivity. Increasingly, we are finding demand for these types of solutions in the corporate treasury space as well as in the non-bank FI and the FI space. So hope that answers the questions. I probably can take maybe one or two more questions. I'll just go through the list here. Yeah, there's a question about the implementation effort that is required for some of these types of solutions, some of these automated solutions. So this is again another very good question. Um, Absolutely true. I mean, there is definitely some amount of implementation effort that is required for these types of solution. But the way I would characterize it, it's very much a one-off effort, right? And definitely once you've implemented these solutions, the benefits are there to stay with you for many years, and you'll probably see the biggest benefits of these solutions during times of crisis like what we are currently going through. Now, again, the other thing that I would probably mention here is that there is a spectrum of solutions available here, right? There could be very simple, plain vanilla things like, doing your FX payments via automated channels, using the cash management channels to do all of your supplier payments and clients' receipts, right? That is pretty simple to do. And, we have large number of clients who leverage those simple platforms and they benefited massively. And then at the more complex end, you have these automated risk management channels that I mentioned, and that does require some time. I'll be very honest about it. Implementation for timeframes for some of these solutions could be a few months, but as I said, again, benefits could be quite long term. I have a couple of minutes and I have more questions that have come in. I can see one. Um, COVID-19 brings more volatility to the FX market. How can you ensure maximum transparency? Very good question again. So I will probably go back to one of my previous slides here on transparency. So this is important actually, right? So the best way we can provide transparency is on channels where clients are interacting, like the web channel that we have, which is called Barclays.net, where we provide the FX rates for all FX payments transaction. Clients can see very much the live FX mid rate and the margins that we are applying. Now, we've taken a decision to price on this particular channel from our FX mid rate, which, as I explained, will converge with the market mid rates. So we've effectively removed the volatility risk on this particular channel for our clients. And that was hugely beneficial to a number of clients, particularly those clients who are making payments in the emerging market currencies. But to answer this question, I guess the maximum transparency we can bring is essentially by surfacing these rates, by streaming these rates on channels that we can. And on our dealing platforms like Box and all, absolutely. I mean, it's all live rates that's being screened. So hopefully that answers that question. So I guess I'm time out on that. So I will conclude my presentation here. Thank you very much for listening. And if you have any further questions, feel free to again reach out to me on my email. My email is basically my first name dot second name at barclays.com. That is sat.khuntia at barclays.com. So thank you very much. Thanks for listening.